Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Short Verticals. And today we're going to be talking about using a phenomenon that happens on a chart, frequently just overnight, that's sometimes used by traders to plan vertical spread trades. We're going to be using stock gaps to plan vertical spread trades. How might that be structured? We're going to be addressing some of the common assumptions and maybe some myths associated with the trading of gaps. And we'll be planning and placing an example trade before we're done. A lot to cover. So before we get to that, though, let me first of all say hello to everyone who's already chatting in out in YouTube. Great to see familiar names, even though I'm kind of an interloper here. I am filling in for 1 week while Brett Crowther's off on the road. I'll be helping as the presenter today. Brett will be back next week. But hello there to Waylon and Scott, Jenny, Robert, Ray, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us in the live stream. This is a Thursday webcast series. It kicks off promptly at 2 Eastern Time. I also want to let our live stream audience members know that Connie Hill is joining us in the chat. It's great to have Connie here. Connie and I have worked together for years, so she brings a lot of experience to this discussion. And Connie's going to be keeping an eye on chats through YouTube, and any questions that come in that I can't get to, she's going to be there to pick up slack for me. Connie and I would also like to issue an invitation to everybody watching, whether you're live or you're watching on the archive, to follow your favorite Schwab presenters on social media. You can find us on X, you can find us on LinkedIn. So Connie can be found on X at Connie Hill CS, that's her handle. I can be found on X at Cameron May CS, or you can jump over to linkedin.com/in and then /Cameron May CS will take you to my profile. Give me a follow there. But if you are commenting on my posts on social media, I just try to reply right back to you. It's the place to connect with your Schwab presenters in between these live streams. But let's get into this discussion, talking about using gaps to plan vertical spread trades. But as we do, of course, there are risks associated with the strategies discussed today, so bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so important stuff. Now that we have that accomplished, let's set an agenda for today's discussion. What are we going to be covering with our time together? First thing that we're going to do is have a look at what's going on with the markets, because I need to use that to set the stage for today's discussion. So we're going to be putting ourselves in the shoes of a hypothetical spread trade investor whose first stop is to see what's going on with stocks broadly, and that might help inform them with which sort of vertical spread strategy they choose to implement that day. Then we're going to use an example stock to explore how that trader might use stock price gaps, those overnight gaps that can appear on charts. What assumptions are commonly made by technical traders relating to those gaps? How might they assist with planning a vertical spread? And then we're going to plan and place a vertical spread trade with those gaps in mind. I think it's going to be an interesting discussion. Let's get right into it. Let's pop over here to the Thinkorswim desktop paper money platform. And I'm looking right now at a 1-year chart of the S&P 500. And the S&P really made a strong move starting right at the tail end of July. It was down to around about 7,300 points, rallied sharply over the course of just a week, just a little bit more than a week, maybe up to about 7,800 points. So it was a 500-point swing, and then stocks have tended to chop sideways since then, with prices starting to kind of peel back most recently. So for some technicians, for some traders who keep a close eye on things like this, they might be wondering at this point, well, if it's starting to fall, how far might prices fall? Is there anything on the chart that might help us with sort of gauging where the next price floors might be? Well, looking at recent history and using a common technical assumption that previous price ceilings, once exceeded, are likely to act as new price floors, certainly not guaranteed to. Where have those ceilings been recently? Well, we'll notice as we look at the last couple of months, in June, the S&P really struggled. June straight on into July, right through the heat of those summer months. The S&P really didn't seem to be able to get above about 75.50, touching that level, what, 1, 2, 3, 4, 5, 6, 7, 8, 9 times. And finally, we broke up and through that. But there was still this potentially smaller obstacle where we touched around that 76.25 level. That may have been a price ceiling, but we blasted through on a particularly heavy day of trading here and a nice strong move to the upside. So if those previous price ceilings might be new price floors, maybe we're down about 0.66%. Could it be that the bulk of the near-term selling is done? We'll see. But let's just say that that's our trader's conviction. Now, I could just leave it right there, but I wanted to bring in one other technical bit of evidence I thought is kind of interesting. Let me zoom in on this period with these two levels, these price ceilings that may be new price floors. And I want to focus again on this really strong rally that we had. Actually, the rally terminated right up there on August 13th, at least for now. So when there's a really strong move on a stock or a stock index, what some traders will do is use a tool known as Fibonacci retracements. I'm going to click on my little active tool icon, select Fibonacci retracements. And this is a tool that might assist with identifying areas of support and resistance. It's one that we actually talked about in my webcast just yesterday. So I'm going to go right up here to the top, that February 13th high, go to the absolute high, including that candle wick, and I'm going to click right up there using this drawing tool. And then I'm going to pull on down. I'm actually not pulling, I'm just moving my mouse down. It's not a click and drag, it's actually two separate clicks. And I'm going to click again. And what I found interesting, Carla says, can you tell me where I'm not sure what you mean there. Carla, could you clarify? Can you tell me where the DEPT, that's typically an abbreviation for department, spread is, yeah, I think there's, a debit spread. Tell me where the debit spread is, please. I'm not sure, Carla. I'm certainly happy to help. As long as it's not too far off topic, I think that can definitely contribute to the discussion. Anyway, for those who use Fibonacci's to assist with potential areas of support and resistance, when there's a strong move to the upside, there's a common assumption that we'll pull down to somewhere between that 61.8 level and the 50% level. And look what those align with very neatly, that high and these highs. So maybe could there be some mounting technical evidence for price floors somewhere in that range? We'll see. It could be another day or two of selling, could be more, certainly. But let's just say that our trader thinks that stocks are likely to bottom out here. So they're still looking at maybe planning a new bullish trade. And for today, we're going to be doing a bullish vertical spread trade for the September 18th expiration. We have August just around the corner. Today's Thursday. These August contracts expire tomorrow on Friday. So how about we structure a trade where the assumption is stocks in general, and maybe a stock in particular, seem to be more likely to go up than down. All right. So let's go. Let's see. It sounds like we might have a few people struggling to join the webinar. That's interesting. Let me know if that issue persists. We'll keep an eye on that. Anyway, but I want to go to our example stock, which is going to be Microsoft today. So why did I select Microsoft? Well, for options traders, not everybody is looking for exactly the same thing from every stock that they intend to trade options on, but there do tend to be some common threads through a lot of stock requirements for options traders. One thing that the trader might keep an eye on is the price per share. The one that we're trading, the stock that we're trading today, kind of on the higher end in share price. That has some important implications that we need to discuss. Trader might also emphasize the liquidity of the stock because illiquid stocks tend to have illiquid options. And those options can be tougher to get into or out of. It can lead to increased cost to get into and out of those trades in the form of what we call slippage. In any case, for some, they look for trading options on highly liquid stocks. Microsoft, one of the biggest companies in the world, tends to have among the most liquid options. All right. Now, a final thing is what's happening on the chart. And what's happening on this chart, interestingly, is somewhat mirroring what we've seen on the S&P 500, a really strong move up and then a pull back. But what caught my attention today and what led me to the idea of this discussion are the Microsoft's tendency at times to have these very strong overnight gaps. So if you don't know why a gap shows up on a chart, basically what we're seeing here is the stock price closing trading in one position on one day, and then some news coming out fairly dramatically impacting that stock price overnight. So the overnight trading, you may have heard of after hours or pre-market trading, that extended hours session of trading. Well, when we close things up at 4 o'clock Eastern Standard Time in the traditional market hours, it doesn't mean all trading halts. There's this extended hours trading that may be reacting to news that happened after the closing bell of the traditional market hours, and that can move price. And sometimes it can move price in a big way. I will say on stocks that, well, one way to say this is most stocks experience a price change overnight. Most of the time, a technical trader doesn't assign any real significance to that. We refer to that as a minor gap. So maybe I'll come back here. You can see actually a big gap, but minor gaps. A minor gap would be something like right here, January 23rd, we closed trading at 265.95, and overnight price moved downward to open at 465.31. Moved down a bit, but there's overlap in trading from one session to the next. We wouldn't really see that, and even this would still be considered a minor gap. On the 26th, we closed at 470.28, opened up the next day higher at 473.70. So what does that move? About a $3 move to the upside, but it's still, there's an overlap between the high of that candle, of the first day's candle, and the low of the second day. So this would be considered by some to be what we'd call a minor gap. But when the candles do not overlap at all, to some this carries additional significance. The stock is on the move in a new direction, and either there's a heightened concern for the stock in the case of a downside gap, or heightened enthusiasm for a stock in the case of an upside gap. And for technicians, there are assumptions that come related to those gaps that may assist in the planning of trades for stock trades or for options trades in the future. So I want to go through those assumptions. Let's scroll forward again here. Actually, let's just zoom back out. Let's come down here and use our little magnifying glasses. I want to zoom out, and let's just talk about this big gap that happened following this most recent earnings announcement. The stock just shot up here, closed trading $390, open trading the next day $437. There's a 47, 48 point move to the upside. What have you heard about gaps? First thing, maybe I'll just start right off with a myth about gaps. And that is, we think we've heard, and maybe sometimes somebody says this, although I would say in traditional assumptions, it's mistaken. Have you ever heard the phrase that all gaps fill? What does that mean? Well, let me draw a line identifying this particular gap. Since this is the top of the lower day, and this is the bottom of the new day, that would be the size of this gap. You'll notice there's absolutely zero overlap right there. When we have that strong move up, if I were to subscribe to this concept as all gaps fill, that would mean that that trader is assuming that the stock is going to come back down and go back through this gap. In other words, that price is going to fall, re-enter this gap window, and then go back down. This is what we call filling the gap, when we cover the same territory in the opposite direction. So that is, it's a phrase that you'll sometimes hear repeated. And I can say some gaps fill. As a matter of fact, there's an assumption that a gap is likely to fill if something happens first. But I do want to address the myth that all gaps fill. As a matter of fact, it's not true that all gaps fill. If you think about a stock that's been trending upward, maybe a company like, I don't know, General Electric or something like that, a company that's been around for a century. Well, if that stock has been going up generally, is General Electric the same price as it was in the 1920s? No, it's gone up. There will be gaps along the way that have never been revisited. Not all gaps fill. As a matter of fact, the typical technical assumption is that the gap will not fill. So here's sort of step number one that a trader might use in planning a trade, and that is, in the case of an upside gap, the initial assumption is that the top of that gap, so using this gap example again, the top of this gap is assumed to be a new price floor if price ever comes back down to that level. Now, the underlying psychology of that assumption is that something just got traders really excited. There is a reason. In this case, it was probably that earnings announcement. But there's a reason that price jumped up like that, and that's provided the stock with a lot of momentum. And unless something new enters the equation to kind of quell that enthusiasm, well, traders may be reluctant to give back that territory that was gained. There may need to be an equally bad piece of news relating to the stock to offset the good piece of news that created this gap in the first place. So if the stock pulls back, the initial technical assumption is that the top of this gap is likely to act as a new price floor or a new support. Now, in the case of a downside gap, the opposite is assumed. So here we had a big, strong downside gap right there. So in this case, we might assume that this is likely to act as a new price ceiling in the event of the stock rallying up to that. In this case, it didn't. Well, that's interesting, because if we apply that assumption to what's happened most recently, there's another more significant upside gap. This is not a minor gap. This is a legitimate overnight gap. And if our assumption is the top side of that gap is likely to act as a new support, that seems to be holding at the moment. Now, before I move on to structuring a trade around this, I do want to revisit that concept of all gaps fill. I do want to talk about a next assumption. If the gap fails in meeting its initial assumption, so in this case, if we have a strong gap to the upside, if it fails to hold as support at that level, and price is able to slip back down into the gap, at that point, the typical technical assumption is that the gap will do what we call fill. In other words, the price, if it's able to get back below the top side of this gap in this case, then its next stop might be heading on down to the bottom side of that gap. So if that's just your initial introduction to gaps, I didn't want to spend the whole time talking about gaps because we have some options trading to do. But let's clean up our chart here. Let me just clear off our whole drawing set. And let's just focus our attention on this gap that just happened, where we had this upside gap. It looks like there's the top of that gap. And I do want to kind of go back for just a moment. Let's zoom in on this. And when we have a strong gap up and then price starts to rise from there, our Fibonacci traders again, remember me using the Fibonacci on the S&P 500, may start to measure from that point. So here we had the huge gap up, a run up, including the second gap, to this peak. I wonder if we were to draw a fib from that high down to that low. Look at this. This is interesting. The top side of this second gap aligns pretty nicely with the 50% retracement. That's even this pairing of technical facts doesn't guarantee that the price is going to go up from here. But let's just say here's our gap trader's assumption backed up by additional technical data that it looks like price might advance from here. Oops, I don't want to draw another fib. That's just going to complicate things. There we go. Let me zoom back out and let's structure a bullish vertical spread trade based on that gap assumption. Now, as we transition here to go planning our trade, I'm going to hit the pause button because I just noticed that there's a survey that's been posted to the chat window for those that are here in the live stream audience. So you live audience members, do me a favor right now, click on that survey link. That'll bring the survey up, and then just sort of set it off to the side until after the webcast is over when you can give me some honest feedback. But please do fill out a survey when you see one. It's never a wasted effort. They're really short to do. So it's 2 quick questions, and then a comments box and a suggestions box. But if you fill out that survey, I just promise you that it doesn't just go off into the ether and that effort that you took gets lost. Nope, that stuff gets sent right to me. And I read through the data, I read through your comments, and it always helps. All right. So let's plan our gap trade here. Looks like we have some signs of technical strength. We have a dividend. We just went ex-dividend on stock today, so a little bit of today's downward activity may be attributable to that dividend because stock prices are adjusted down on ex-dividend date in the amount of the dividend. Anyway, but how about for this trade? Let's see if we could structure. Maybe if I zoom in here again, let's get kind of nitpicky here. So it looks like that gap low is around the 475 mark. Yeah, as a matter of fact, it's not around. Look at the L right here for low. I shouldn't say the gap low, the low of the candle of the gap day. So it's the gap high, but the candle low is at exactly 475. I wonder if we could structure a bull put spread maybe down at 470 or lower. Let's go have a look. Bogus Chinchilla says the 50% is not a fib number, so why use it? You're right, it's not from the Fibonacci sequence series, but it is a common proportionate retracement assumption for technical traders. That's why. But it's actually not a true fib number. The other ones are 78.6, 61.8, 38.2, 23.6. Those are fib numbers. 100, 50, and 0 are not, but still commonly used in Fibonacci's. Matter of fact, couldn't really do it without the 0 and the 100. Anyway, but let's maybe see if we can structure a trade. I don't need this fib anymore. Let's remove that. And what if we were to plan a trade where the trader is going to be in position for their theoretical maximum gain if we're able to just stay at least above 470. Maybe we can go lower than 470. Oh, we certainly could. It just changes the probabilities and the reward. But should we look at 470 and 465 initially? How about that? Let's go to the trade tab and structure our trade. So when a trader is bullish on a stock, they can buy a call, they can sell a put, they can do all kinds of variations on those 2 themes. But what I'd like to do today, since this is a Short Verticals webcast series, there are basically 2 types of short verticals. There are bullish ones and there are bearish ones. Let's do a bullish one. That's going to be structured using puts. So I'm going to go over to the put side of the columns here. And let's start off by looking at the 470 strike. Those of you who use delta as a gauge for the probabilities of a trade, looks like there's about a 35% chance that the stock on the 18th of September winds up below 470 and outside of our maximum gain territory, about a 65% chance that, that the stock will be where we need it to be at expiration. If it helps to visualize, let's draw a little green box here. This is where we'd like to be, above 470, if we use these strikes that I'm planning to use here. All right. For the 465, looks like about a 30% chance that we might be in max loss territory. Now, delta, it's not just used for as probabilities by options traders. It can also be used to get a gauge for how much an option might make or lose on a $1 move up or down in a stock price, but I'm just looking at it through that sort of probability lens right now. And let's start to map out our example trade. Our example trade today is going to be, it's known as a bull put spread. And it is a spread that results in a credit. It's also known as a short put spread because when we sell something in the investing universe to enter a new position, we say we're short that thing. We can short stock, we can short options, and so on. Anyway, but let's initially sell the 18th of September for, let's look at that 470 put. It looks like it's trading for around 885 to 910. You look at that quote right now. So maybe we can get $9 for that thing if we sell it. So what we're doing here is we're entering a contract where someone is theoretically paying us $9 per share. On 100 shares, that's 900 bucks they're paying us. And in exchange, we're making a contractual promise that they can sell shares to us for $470. They can sell 100 shares of Microsoft to us for $470 entirely at their discretion at any time for the next 29 days or through the 18th of September. Jay says, is this the same as a short call vertical? No, Jay, it's a good question. Short call verticals are actually bearish strategies. This is a bullish strategy using puts. And I'll explain why. So, but to create the vertical spread, we need to do two options contracts. We sell one and then we buy one at the same time. So at the same time we sell a contract, we're going to buy a less expensive contract. So if this one's around $9, maybe we buy like the 465, it's less expensive. It's more like $7 and maybe 30 cents. Let's say that we were able to buy that 465 put for $7.35. Now, prices are changing. Actually, yeah, I might need to update this. Let's update our assumptions here. Let's say it costs, we collect let's call it 880 for this one because prices are changing. And the 465 is $7 and maybe 25 cents. There we go. Well, what are we doing here? I think it's always important to pause and really process what we're getting into. We're getting into two different contracts. Contract number one is this is where we're receiving a payment for someone else in exchange for a contractual promise. So the payment is $8.80. The promise is that they can sell shares to us for 470 bucks if they want to. The second contract gives us the outlet if we need it for where we're going to sell those shares if we need to. So the second contract, we're spending $7.25 to make sure that we've arranged for someone else to buy our shares from us if we wind up getting stuck with them. So in this case, paid $7.25, and for the next 29 days or through the 18th of September, we have the right to sell shares to someone else for $465. Now, the net effect of doing all of this is that we collect a credit. We collect $880, we spend $725, the net credit here, which is also the theoretical max gain of the trade. Let's spell gain correctly. Is the 880 collected minus the 725 spent, or in other words, $1.55. This is assuming we're able to get these contracts filled at the prices that I've kind of jotted down here. These things are changing as we speak, so it might be a little bit more than this, it might be a little bit less than this. But this is the motivation of the trade. We can make $1.55 if this goes well. Well, there's also a risk in this trade. The theoretical max loss of this trade if we wind up getting those shares sold to us, according to the first contract, we have to buy the shares for $4.70, and then if we sell those shares for $4.65, let's do this math, $4.70 minus $4.65, I think you follow that one. That'd be a $5 loss, except we did get paid $1.55 to set this whole deal up, so that will leave us with a net loss of $3.45. If I've done all my math correctly, there we go. Yeah, Bogus Chinchilla says a larger maximum loss. That's absolutely correct. Yep. With vertical spread trading, there's a teeter-totter effect. What we all wish is that we could structure a trade where there was a really strong probability of making the money that we're planning on, and also there's a higher reward than the amount that we're risking. It doesn't work that way with vertical spreads. Instead, it's a teeter-totter. The higher the probability of success, the lower the reward. And the lower the reward, the higher the risk of the trade. So there's a teeter-totter going on here. Two Continents, One Island says, are there any risks associated with using a wider spread, say $10 or $20? There certainly are. Maybe we could quickly run some numbers and explore that. But in any case, the reason why a trader might be willing to accept a trade where, hey, I can make $1.55 or I could lose $3.45 is that it's actually much more likely that we make the $1.55 than that we ultimately lose the $3.45. The probabilities are right here on our screen. Where do we need the stock to be? This is called a bullish put spread. That's because we'd prefer for the stock to be above the spread, which is actually where it is right now. It's at 481. And even if it goes down, we're still in maximum gain territory. If it goes up, then we're just deeper into maximum gain territory. Mary Burns says, does the dividend impact the trade? It would have, Mary. It's already been built into our prices, so it's not going to affect our trade anymore. The stock price has been adjusted for the dividend. That has been adjusted in the options pricing as well. So no, not anymore. Okay. So I do like to go through quickly just what can happen. Let's talk through some basic 3 things if we just put this trade on and just let it go. Let me zoom in maybe a little bit closer. So here's where the stock is. Well, it might do this going towards September 18th. It might do this going towards September 18th, or it might even squeeze right in here between our 2 strikes, 470 and 465. So up here, what if the stock goes up? Or what if it just stays above 470? Well, somebody could sell us shares for 470 at that point. They're probably not going to. They're going to say, forget it, Cameron. I'm going to keep my shares because they're worth more than 470. And we keep their 880. Great. At the same time, we have the right to sell shares to someone else for 465. Well, we don't necessarily want to do that because they're worth more than 465. So that 725 is lost. So we keep the 880, lose the 725. Net is $1.55 gain up here. Well, what if the stock comes down here? Let's draw in a little box. Let's draw in a second box right down there and make that red. Let's go to our color palette, kind of give it a pinky color. There we go, so we can see through it. There we go. What if the stock comes down below our vertical spread? So it's below 465 bucks. Well, that trader who has the right to sell us shares for 470, they're going to do it? Yep, almost certainly. They'll sell us those shares. Then we unload those shares for 465 because that's better than selling them at 444 or 450 or whatever the stock is. That's a $5 loss. We have a $5 loss on our stock. We only collected $1.55 to get ourselves into this mess. So our maximum loss is realized. Now, finally, what if the stock price goes down in between our two strikes? What if it's at 468? Well, the trader who has the right to sell to us for 470, that's better than 468, so they sell us those shares, with very rare exceptions. We don't want to sell for 465 because the shares are worth more than that, so we don't exercise the contract to sell at 465, and we wind up keeping the shares. Now we're shareholders over the weekend, and that can change the profit and loss from here, right? So just be aware that if we're in between our strikes and we allow this to get to expiration, we might wind up waking up with new shares. And 100 shares at $470 a share is $47,000 that gets spent. So maybe we might have a plan to exit if we're getting closer to expiration, we're concerned about being assigned below that 470, but while we're still above 465. Now, I'm going to place this trade as currently constructed, but somebody else says, what if we did a wider spread? Well, let's say we did the four. Now you said 20 bucks. Let's go for the more extreme scenario. So let's say that we sold the 470, collected 880, and instead of buying the 465, we bought, let's say, the 450. That would only cost us like $3.80, right? Let me get the right numbers in there. Well, that would actually leave us with a $5 credit. We only spent $3.80. That would leave us with a $5 credit. Awesome. Higher reward. With spread trading, here's what happens. When that reward number goes up, the risk also goes up. So let's do the rest of this. This is the fun part, figuring out how much we can make. How much might we lose? Well, instead of potentially having the shares assigned to us at 470, but we can sell at 465, now, worst case scenario, we might have to sell at 450. And 470 minus 450 is not a $5 loss, it's a $20 loss. And even if we subtract our larger credit from that, if we get sold the shares at 450, so pardon me, if we have to buy the shares at 470 and we sell at 450, $20 loss minus our $5 credit is a $15 risk. So did the risk go up? It absolutely did. Yep. So the reward goes up if we do that. The risk, the bottom line risk number goes up, but interestingly, also the likelihood of incurring this maximum loss goes down because the stock needs to fall not just down below 465, it needs to go all the way down below 450. That's just less likely to happen. As a matter of fact, it's only about an 18% chance that that happens. So there are pros and cons to the way that we structure these vertical spreads. But I think we're going to go with our initial trade. So I'm going to hide this because it's going to throw all of our numbers off. And instead, let's go place the 470, 465 vertical spread. Here's a quick way to do that. Come up here where it's showing us all the single strikes so we could trade each single strike. I'm going to change that to vertical, and it pairs them all up with each other. And we just find the one that we were interested in, the 470 and the 465, and we click on the bid price to sell that. We were thinking that we might be able to get $1.50 out of this. It might not be that much. Let's say that our trader is willing to accept maybe even, let's say, $1.45, kind of halfway between the current natural and the current mid price. So let's set that as our limit. Even then, we may not get the $1.45. But notice this has created an order to sell the 18th of September 470 put and to buy the 18th of September 465 put. We can create a limit order, make sure that we adjust our quantity. Each one of these contracts represents the potential exchange of 100 shares. So if it says 10 contracts there, that'd be 1,000 shares that we might be buying and selling. But let's click confirm and send. I'm not actually going to submit this order because I'm just stepping in for Brett this week. I won't be here to talk with you next week about this order, but I wanted to show at least how it works. So this would be an order to sell this one Microsoft vertical spread, the 470, 465 put, attempting to get at least $1.45 for it. If we fill, our minimum credit would be $1.45, giving us a maximum profit of $145. Max loss would be $355. And there are commissions to be paid for selling and buying these puts. So that would bring us to a total of $1.30. That would chip away a little bit at the net credit received. And we just send that order off and we'll see if that fills. But guys, we've actually accomplished what I set out to do today. I wanted to talk about how for some traders, when there's that big overnight move, that might actually come with some assumptions about where the stock is likely to go next, and that might assist with the planning of vertical spread trades. So hopefully that's been helpful for you. I'm going to let you go. Two Continents, One Island says, do you see any need to protect this position further? I think that, yeah, having an exit plan, generally a good idea. Now, the exit plan might just be let come what may, right? It might be, hey, the trade either works out and I make my $1.45 or whatever, 145 bucks, or I lose 355. The trader might be perfectly fine with that. Even assignment, they might be perfectly fine with, or they may want to take steps to manage each of those outcomes, which is why you may want to check out some of our webcasts that focus on exits. All right. Bogus Chinchilla, my pleasure. Robert, thanks for giving me your time again today. Guys, I'm going to let you go. But as I do, I want to give you a quick reminder of the resources you have available to you from Schwab Education. Starting with these webcasts, if you're new to our channel, make sure that you subscribe to our Trader Talks channel on YouTube. So the full title of the channel is Trader Talks Schwab Coaching Webcasts. This is where you can join our live streams. You can also find playlists of previous webcasts, or you can do keyword searches through our archives for items of specific interest. So like maybe you're working on your vertical spread exits. So I might type in here, vertical exits. And here's a webcast right here from Connie, trading vertical spreads, managing winners and losers, and then also taking new setups. All right. Now, Connie and I would also suggest you follow us on social media. You can find and follow your favorite Schwab presenters on X or on LinkedIn. You can find Connie on X at Connie Hill CS. You can find me on X at Cameron May CS is my handle right there. And if you comment on one of my posts, if you reply to one of my posts, I just try to reply right back to you. And that's the way that you can communicate with your favorite Schwab presenters in between the live streams. Or you can hop on over to LinkedIn. Go to linkedin.com/in and then /Cameron May CS will take you to my LinkedIn profile. Comment on a post here. And again, I just try to reply right back to you. All right, everybody, thanks for your attendance. Thanks for the comments. Thanks as well to everybody that's already clicked the thumbs up. We have about 100 people watching the live stream right now. 42 have already clicked that thumbs up button. Definitely appreciate that. It also helps my videos find well, it helps YouTube promote my videos every time you click the thumbs up. So always click that thumbs up if you've enjoyed one of our webcasts. But guys, finally, a final reminder to fill out that survey. Click on that survey link that Connie has kindly reposted a couple of times. And if you take the time to just fill out those 2 questions, the comments and suggestions, I read through it. It always helps. All right. Kevin, thank you. You have a great day too. I'll see you all in a future webcast. I'll also look for you on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.